Good morning, everyone. My name's David Moore, and thank you for joining us today. We've got a great program ahead and a lot of people on the line. So thank you for taking an hour of your day to join us. The title for today's presentation is the 1031 Exchange, Holding Periods and Exit Strategies. So obviously with COVID, we've got a lot of stuff going on, and we might have a lot of clients that have abbreviated holding periods, and there's lots of misinformation on how long things need to be held to be considered held for investment. So we'll talk about that. We're going to talk about what you can do if you want to get out of the real estate. You know, if you've got people that are in certain states, we seem like the property owners have lost all their rights of ownership. So we've got people that are upset, needing a place to go. And hopefully we're going to give you a variety of solutions to that question. One that is not in the program today that is out there, and if you'd like more information on it, please let us know, is the Opportunity Zone. Probably have a webinar on that alone at some point. Once again, it's one of these items that's under attack if President Biden's certified. So we have to look at what we have today. We understand what the laws are today. We don't know what they're going to be in a few months. But let's go forward with what we know, and we'll talk about solutions to maybe problems you didn't know you had. So I'm David Moore. I'm one of the co-founders of Equity Advantage. My brother and I started the firm 30 years ago, and we handle tax-deferred exchanges, obviously, with Equity Advantage, 1031exchange.com. We've got a sister company that takes retirement funds and we put the IRA Advantage together to accommodate actually our 1031 clients' desires through the many years. They'd heard they could take their IRAs and 401k funds and go buy real estate and other non-Wall Street assets, and wanted to know more about it. We would explain how to do it and talk to them a year later, and they wouldn't have done it. So about a dozen years ago, we put IRA Advantage together to accommodate that side. So next time you're thinking about a piece of property, and maybe you've got a client, maybe you are the client, and you think, gee, I wish I could buy that. I wish I had some money. Maybe you do, you just don't know it. And we can get you through, get you into that real estate or notes or loans or any type of tangible asset with that side of the business. But you know, the only dumb question in any of this space is the one that's not asked. So we're not going to have time to address questions during the program. We will address them electronically afterwards, and therefore, if you've got something, you know, put it up there. There's a menu on the right side of the screen there. There's a section on questions there. I will watch those if it's something I'm covering. That I'll make sure to point out that fact. But you know, let's get going, and we've got a lot of information. So this is the first time I've given this presentation. I'm just going to warn you, we probably will run over an hour, but I'll do my best to keep it short and tidy. So thank you, and away we go. So everybody should be able to see this screen in a moment, and it's the title screen. And at the bottom of that screen, we've got a little slogan in there that we like to use. You've worked hard for your money. We work hard to keep it yours. You know, the bottom line is, and my background was real estate investment before getting in the exchange business. We used the process for our own deals. And we would do what we would call a modified flip. I get a kick out 30 years later. You've got different investment organizations that have, you know, put some acronym to this thing. But what we do, instead of flipping property is property held for resale. You're stuck with normal income tax on it. You don't have the ability to do an exchange. There's 9 points in what's called the Clarkowski court case that we use to determine dealer status. And if you got 1 or 2 strikes, you know, against you, then it's not a problem. But you know, it looks like actually we bumped into our ceiling on attendees. So I apologize if there's some people out there that want to get on that can't. So if we look at what is going on in today's world, like I said, there's lots of information out there that's not accurate, and you know, we're going to try to dispel that. So the bottom line, we like to, you know, look at this stuff, and we've worked with clients, and this is the great thing about America, right? Anybody can, you know, make a great life in this country. And you know, one of my favorite stories to tell is one of our clients that actually immigrated from Vietnam here. He came to the United States with little, worked as a janitor getting started, just tried to work as much as he could, made that jump getting his first piece of property, and he snowballed that into, a multi-million-dollar, estate. And it's all because of his ability to keep his money going, keep it intact, keep it rolling forward. And a lot of times, the bottom line with any strategy and exchanging has always been swap till you drop. And I just want to warn you, that's something that could go away once again if we have a turnover in the presidency here, and we'll talk about some other things in a minute. But people, unlike IRAs and 401k plans, and as I said, we work with those too. When you're looking at 1031 exchanges, it's a tax deferral. You're moving that basis and gain forward. At some point, you're going to pay the tax unless you swap till you drop, or use a few of our different end games at the end of this presentation. If we look at IRAs and 401k plans, the issue, and we work with those also, the issue with that is at some point you've got to figure out how to get the money out. And unlike 1031, where at the end of the day you're looking at long-term capital gains tax rates, you look at IRAs, 401k plans, those distributions are taken at normal income tax rates. So one of the proposals is to get rid of 1031, and I can see where a lot of the Wall Street world says, hey, we don't have anything like that. Why should 1031 be there for real estate when we don't offer anything like that? Well, it's not true. Think about IRAs and 401k plans. There's tens of trillions of dollars in Wall Street that's qualified money. All of that stuff is automatic rollover, tax deferral on those things. Imagine if every time you sold a stock, in a retirement account, you had to pay the gain on that stuff. And you've got to keep your eyes peeled too for this mark-to-market stuff that's being bannered around by our politicians. Imagine with real estate, you get hit with a mark-to-market situation on taxes. You haven't realized the gain, and they're going to treat it like you did. So lots of crazy things out there right now, and we're definitely going to try to keep everybody up to speed on it. If you've got questions, you want to stay up to date on things, please sign up for our newsletters. And you can sign up for those. Just reach out to C Moore, M-O-O-R-E, at 1031exchange.com, C Moore at 1031exchange.com to get on there. But the bottom line is, you've worked hard for your money. We want to work hard to keep it yours, and there's a variety of tools there, and we're going to talk about them. So if we're talking about real estate, one of the things sort of interesting is, what are you selling, and really what do you want it to be? And typically we're looking at a couple different tax codes: 121 for the residential exclusion, 1031 for investment property. You've got 1033 out there also for involuntary conversions. But you're typically going to be looking at one of these two categories, and sometimes you'll have a blending of both, and you can also convert one asset to another class. So I mean, you've got a primary residence. Think about anybody in California, or any typically, I mean, DC, the West Coast, anybody that's got gains in excess of the $250,000 or $500,000 exclusion, you're not stuck with that. I mean, you can move out of the property, establish it as an investment property. You sell it within 3 years of moving out, you're still entitled to the exclusion. So, understand that we've got lots of situations where somebody might come into us and say, hey, and for the brokers out there, think about this: if you've got a client that's got a lot of real estate, a high net worth individual, it's likely that their home's going to be in this situation where the gains on disposition are well in excess of 250 or 500. So even if you're a commercial broker, you need to be aware of what 121 does. There's an example at the end of the presentation that talks about a converted asset picking up 24 different replacement properties. The person went from $1 million tax hit to none by conversion, and then ultimately seasoning, and then doing an exchange. So 1031, same situation. Maybe you want to exchange into a property that you ultimately convert into your primary residence. You can do that. There's rules that apply. The government acknowledges this can be done, and we will talk about a little bit of that later. So think about a situation where maybe both these codes apply to single asset. You could have a farm with the home and the working land, a duplex, half owner occupied, half non-owner occupied. Think about what's happened this year with COVID, everybody working from home. You might be doing tax planning at the end of the year here, and your CPA is saying, hey, maybe you ought to treat your home office as a home office and for tax purposes, and now you start taking depreciation on it. Well, what happens if 5 years from now you go to sell that home? what are you selling? You're actually selling a home and investment properties. That component of that home office portion would have to be exchanged, or you're going to have tax exposure on that piece of it. So there are situations where you can have a single disposition with allocations both directions. There's situations where you maybe want to take a primary residence, convert it into an investment property to get away from the universal exclusions 250 or 500. Situations where you want to take 1031 and exchange it into something that becomes 121. And we've got to be aware that, you know, if you did that exchange into a property, converted it, and sold it inside 5 years, it'd be a fully taxable sale. Even after the 5 years, you're going to be subject to something called the Housing Assistance Tax Act, which we'll talk about a little bit more later. So this slide, it's really important. I think anytime you look at selling a property, you got to sort of look at this slide and, hey, well, what is it that what's it appear to be, and what I really want this thing to be? And with time, we can fix things a lot of times. But you know, in a situation where for the people, I always use examples of, you know, scuba diving. If you scuba dive, what's the strategy? Is you plan the dive, you plan the dive, you dive the plan. If you're a pilot, you're going to file a flight plan. If you've got a boat, you're going to have that float plan. But you know, you plan ahead, ask the questions in advance. We're just one member of a successful team of investment professionals. I would say your tax people are probably one of the most important. Good legal people. You want to have tax and legal people that you're paying for an opinion, not paying to learn something on your behalf. So keep that in mind. But lots of good professionals out there, good tax and legal people, finance people, property managers. Think about in states anywhere on the left coast, we've got so much in the way of tenant rights, and the laws keep changing. I don't know how some investors can actually keep on top of those things, but be aware that you know, good tax advice is really paramount. When we're converting assets, doing different things with it, changing ownerships, you know, you want your tax people to know that you did this exchange or you're contemplating it. Talk to them before you sell the property. Talk to them ideally when you're going to list the property. Don't give them a call April 14th and say, hey, all this stuff happened. So, you know, just because you got them doesn't mean you're using them. Please use them. So we're talking about seasoning, and I made that comment about, we all hear the ads for people flipping property, and the problem with flipping property is, you know, it's a business, it's not an investment. I've got people with IRAs and 401k plans that want to go out and flip properties. Same situation. You might have a Roth IRA and you think, hey, I'm not going to have any tax exposure flipping properties with that. You might have been told that. That's not true. You're going to be subject to something called UBIT or UBTI, unrelated business taxable income. And that applies to things where you've got this investment primarily, but then you're doing things with frequency, and it's now becoming a business instead of an investment. And the government doesn't want these tax privileged entities competing unfairly with the taxed world. So, you know, if you, an easy example for UBIT in a retirement account would be, let's say you roll your funds into a self-directed IRA or a 401k. And you go out and buy an apartment complex. The apartment complex has a laundromat in it. Well, the laundromat's a component of the investment in that situation. So that laundromat does well. You think, hey, that's great. I want to go buy a laundromat. So you go buy the laundromat with your even Roth IRA, let's say. Well, what have you bought? Is it an investment? Well, yes, but it's also a business. So even in that situation, even with a Roth IRA, you're going to have tax exposure on that income. And it's not a reason to do or not to do something. It's just another component to think of. When we're looking at flipping properties, you've got to understand what the person does for a living, how often has this happened, you know, what was their intent when they bought it, what they did with the property during the time they owned it. Holding periods is not the solution to any question in this space. You've got to look at it and understand a variety of factors. It's a court case way back where 5 years was deemed not long enough to satisfy the 1031 requirements. In that particular court case, the reason it failed is, you know, they bought the property, they took 5 years to sell it. They bought it, put it back on the market immediately, and it just took 5 years to sell. So it failed. On the other hand, we can point back at this recent case, it's just a few years old now, and point at it and say, okay, 4 months was long enough in this situation. And really in this particular court case, we have to look at it and sort of say, I don't really, I know when people are entering into an exchange just to buy a home and move into that stuff. So in this situation, I don't know what the true facts were, but bottom line is they bought the property, documented showings, documented the, the listings for rent, argued they could no longer rent the thing, couldn't afford to hold both, sold their home and, moved into the property after 4 months' time, and they were audited, taken to court, successfully defended it. So when I have people, and it just happened again this morning, somebody told me, well, gee, they got to hold the property for 2 years. Well, that's often, a response to how long is long enough. And all I can say is that 1031 doesn't, contain any straight up required holding periods. It has to do with intent, and like if I look at that Clarkowski court case, there's 9 points that are used, and once again, it's going to sort of look at it and say you've got a pattern there. How often have you done it? What do you do for a living when you bought it? What was your intent when you sold it? What was your intent? What did you do with it during the time you owned it? And for example, you could buy a property and receive an unsolicited offer maybe a month or two later. And if the offer is too good to pass up, you could take it and roll into another exchange. Now, don't get lucky too often, because now you're establishing a pattern, you got a problem. On the other hand, like I said, if you bought a property and all you did was prep it for sale and it took a couple of years, those 2 years wouldn't be long enough. So you want to finish the thing, hold it, season it for a period of time before you do anything. How long is long enough is going to be driven by you and your tax counsel. The code does not contain a black and white answer there. It does if it's a related party transaction. So if I've got a transaction between my brother, we want to swap into different properties, or if we both swap and we both hold our respective replacement properties for no less than 2 years, we've got a defendable exchange, not a problem. If we can document there was no intent to avoid tax, that 2-year hold period doesn't even apply in that situation. So you got to be careful with what's going on. And once again, who's the most important person in there? Your tax people. If they've got concerns, we're happy to talk to them. We'll get them, any case law we see in that scenario that's going to help in the decision. And maybe if people can't get on the same page, you engage your legal counsel, and we build the case for an audit that we hope never comes. So the deal is, we don't want anybody to have a problem. We want to be able to defend the actions, and that intent is the big deal. But if you bought a property, if you bought a property recently and now you're getting hit with some state, for example, I've got so many clients in Oregon right now where the governor has basically said, hey, you've got a rent holiday until March, and don't worry about it. And now you, the property owner, are in a situation where you might be arrears in payments, and where's your help? So or maybe you're just scared this is going to happen. Well, if you want to get out, you should be able to justify it. Talk to your tax people. If they've got questions, give us a call. We'll get you some information on it, help you out. But once again, if you bought an item with the intent to hold for investment, you're not doing anything that's considered a dealer issue, then you're not going to, I shouldn't say you're not going to have any issue there, but you should not. You just want to be able to defend your actions. And once again, we've got court cases where as little as a few months' time have been deemed long enough under court actions. So it all has to do with intent. Cornerstones. So we got to get everybody on the same page before we go into end games. 1031s, I like simple, all right? So keep it simple, stupid. The old KISS principle, 4 cornerstones of the exchange. It must be an exchange. Something is given away and something is received. This code is almost 100 years old, all right? It's attacked again this time under this campaign. But understand that people still don't understand. It's got to be set up pre-disposition. If you close that property, if you have actual or constructive receipt, the ability to touch the money, it's too late. And we still have people almost 100 years later, the final guidelines really came down in 91, but this has been around a long, long time. And people still don't understand it's got to be set up pre-disposition. So make sure, if this is something you're contemplating, do not let something close before you ask those questions. So something's given away, something's received. The items relinquished and received must be of like kind, and it's always been the same. I had a lot more hair 30 years ago, and people would say, well, I remember when it used to be house for house, land for land. It's never been that way. So the deal is it refers to the nature of the investment rather than the form. Any real property held for investment is going to be like kind with any real property acquired with the intent to hold for investment. You can go from a rental house into an apartment building, into a strip mall, a place on the beach to retire, into a Delaware Statutory trust, a TIC, or any of those other items. But the deal is that we're looking at a nature decision, not form. So you're not going single family for single family. Whether an asset has rental income is irrelevant. If you exchange out of a rental house into a piece of dirt, it doesn't have to generate cash flow. You could buy a house and just hold it empty. It does not have to be rented out. It's what you're doing with this thing. That could be acquired with the intent. Obviously, you're going to want to have, most people want to have cash flow, need cash flow, but it doesn't have to be there. So 2, items relinquished and received must be of like kind, nature rather than form. The napkin test is what tells us what somebody has to do. And I'm so tired of hearing people say, you got to replace debt in an exchange, all right? What the napkin test says is you must go across or up in value and equity. Those numbers are net of closing costs, not the gross. And in addition, so normal transactional costs are going to be able to be paid at settlement without a tax consequence. Once again, we've got a gray area there. If you've got questions on those normal transactional costs, you can reach out to us. We'll send you a page that's sort of, a guidance page. It's not law, but typically we're looking at costs that would be normal to any transaction: title escrow fees, tax and legal fees, the proration of property taxes, brokers' commissions, hour fees. Those things are all considered normal costs. Elective fees, like points on a loan, that's something you're just paying to buy the loan down. That's going to be elective fee. That's going to be taxable. The deal is, once again, back to the tax council. You've got to look at how these things are treated, whether it's a quote unquote normal transactional cost, or it's something that would be considered boots, anything that's received that's not of like kind. Typically it's going to trigger tax exposure. Tax exposure is one thing, but it's up to you and your tax people to look at those settlement statements and deduce what's a normal transactional cost, in your opinion, that would not trigger any boot exposure, and what is not. Maybe a lender required repairs there. How about the seller paying buyer's closing costs? Well, the buyer's closing costs, most people are going to treat as a reduction in sales price. Lender required repairs, you're paying a fee, and it's probably going to be, maybe normally it would, if you're doing maybe some capital improvement, even normally it'd be capitalized, maybe you want to expense it to offset the boot exposure. So these are all things where your tax counsel needs to be one of your best friends in this world if you're doing real estate investment, because they're going to be there to help coach you and keep you on the rails. And if they've got questions, we're happy to talk to them about any of those things. The napkin test says you've got, like I said, a cross or up in value and equity. People always throw debt into that transaction. They think, well, gee, I had this much in mortgage, that's going to impact what I have to spend. Or I've been told I have to replace debt on the replacement property, which once again is untrue. Debt can go away 2 ways. One, by going down in value, triggers tax because you went down in value. The other way debt goes away is by adding cash. Think about recessionary times. What happens to a property? Typically, you've got an erosion of value, and the lending requirements get tighter. So the loan to value is decreased. Meanwhile, your equity is decreased. So typically, people have to throw money in. And during that last crash, we had people calling all the time. Do I have to pay the property off because I can't qualify for lending on the new one before I do the exchange? Totally unnecessary. Don't have to do that. That debt once away can go down 2 ways. One, by going down in value, triggers tax because you reduce the value of the replacement property. The other way debt's going to go away is by adding cash. So we like to say you can offset mortgage boot with additional cash. You cannot offset cash boot with additional mortgage. Finally, number 4, continuity vesting. Biggest headache we have next to times. Taxpayer that relinquishes has to receive this. Think about a situation with a limited liability company, and think about what happens. You might have a situation where you've grown your portfolio from 1 to 10 or 20 units over the years, or 50 units, or 100 units, or 1,000 units. But the idea is, a lot of times people will start off with a single rental house, then they'll get another one, then they'll get another one, and then somebody, maybe their lawyer says, hey, you're now subject to some liability here. Maybe we ought to throw them into a limited liability company. And that's a great idea. But the deal is that if you put it into a limited liability company, now you relinquish the property. If you're in a community property state, we can go in and out of a limited liability company as spouses. We can't do it as a group of partners, but as spouses in a community property state, we can go in and out of that LLC. And why would you want to go out of the LLC on acquisition? If you were talking 4 units or less, well, maybe the cost of the money on the replacement property is going to be more if it's in an LLC's name. So you've got to think about this stuff. And if you put that LLC together for 4 units or less, you're probably going to have that situation where the loan's going to be more expensive going forward. If you're in a community property state, you could drop that LLC through the exchange, acquire individually, and then contribute to the LLC again in the future, and that would be okay. If you're in a non-community property state, you can't do that. So, for example, I'm sitting here in Portland. Don't hold it against me, but I'm sitting here in Portland, and in Oregon, people cannot give up a property. A husband and wife could not relinquish a property in LLC and receive a replacement property individually. They're going to have to go forward in the LLC's name. So that's one of those situations where, when we get an exchange started, first thing we're going to want to see is the title report. And keep in mind, title, that deed doesn't necessarily indicate ownership. I could sell you a property on a land sale contract. You own the property, yet I have title until you pay me off. So, you as a broker, if you've been doing brokerage for many years, you've probably had this happen where you list a property, you get that trio, and it shows somebody else on title than what you expected. And you got to understand that deeding things back and forth, you're deeding the equity in the property. So between spouses, deeding back and forth is one thing. Deeding things back and forth between other individuals, including kids, that's a totally different thing. And you got to be aware of the gift tax limitations to everything else that's going on. We'll talk about that a little bit later. But these are my 4 cornerstones. Got to be an exchange. Relinquished and items relinquished and received must be of like kind. For total deferral, you need to satisfy the napkin test, cross her up in value and equity, and then finally, you've got to have continuity of vesting. If I was talking about a retirement account, I've only got 2 bullet points. One, what are you buying? And IRA can buy anything other than collectibles, life insurance contracts, or stock in a sub S corp. 401k plans can literally buy anything other than collectibles, so it's very, very broad. And so one, what do they want to buy? And 2, who are they transacting between or for the benefit of? So any transaction between or for the benefit disqualified party would constitute a prohibited transaction. So that's, once again, another presentation. If you're interested in finding out more about IRA's 401k plans, taking that money to go buy real estate, other assets, sign up for the class tomorrow, and we'd be happy to have you attend. Timelines. 45 and 180 days. All right, you've got 45 days from settlement to ID what you'd like to acquire, 180 days total time to complete the exchange. The 45, 180 start at settlement. It's not 45 and then 180. Also, you got to be aware transactions happening late in the year. It's 180 days or the due date of the tax return. So make sure if you're not going to complete the transaction before April 15th, you need to file an extension so you don't get stung and artificially terminate your transaction, which in 30 years to my, I'm aware of only one of our clients that had that problem. And it happened because it was 2 partners doing the transaction. The partner that we always work with didn't know the other partner had filed the return, right after the first year, and it sunk it. So make sure that you're aware of what's going on there. Complete the transaction before you file the return. And, part of that, the reason for that is it's possible to, have the tax consequence of an exchange span 2 years tax terms, because, sometimes you're going to have some taxes that are owed in the year of disposition, depending on what's going on with boot, and the balance could be due the next year if that's when the balance of the funds are returned. And that sort of segues into another slide later when we talk about when you're entitled to receive funds after the exchange company's got it. Now, something I want to say is that more importantly than ever, you can go ahead and negotiate the purchase of anything, put earnest money down, predisposition. You just can't own both, new and old properties at the same time. So you go ahead and negotiate the purchase, put earnest money down, do whatever you want before relinquishing the property. And that's going to be fine. If you put earnest money down on the replacement property, just let us know whether you want to be reimbursed that money when we go to buy the property or not. You want to leave that earnest money in, but that's going to be totally fine. I just say, people ask me all the time, hey, when do you want to know about the transaction? And or when do I want somebody to think about an exchange? I'm going to tell them when they buy the property, but at least when they consider a disposition. It's really important. One final comment on this slide: these timelines are not extendable. All right, short of a presidentially declared national disaster. So we've never had an extension to 1031 until 9/11. That was the first. Now we typically have them with any national, presidentially declared national disaster. We did have one for COVID earlier in the year. I don't know. It's sort of like the PPP money and everything else. I don't know. It seems like everybody was so worried about it at the beginning of the year, and nobody cares about it. Or nobody. It's not that nobody cares, but the politicians have sort of forgotten about anybody that's encumbered with these extensions. Or potential problems of COVID right now. But if we've got any notice that any further extensions are going to be there, we definitely are going to get word out. Those notifications we send out via our newsletters. Property ID. 3 different options. I hear people all the time say, well, you got to ID, 3 properties. You're capped at 3 properties. That's not true. You can actually ID any number of properties, but the rules get more complicated as you ID more properties. I'm gonna tell you should ID, 3, or ideally get your exchange done inside the 45 days. Then whatever you do, you don't even have to turn in an ID. But you can ID something on day 20, change your mind day 25, 30, 40, 50. Not 50, sorry about that, I got too excited. 45 is it, right? But the deal is today, you really have to be diligent, because on that 45th day, you've got to be either committed to completing the transaction or pull the plug on it. There's going to be a couple end games that talk about fallback options for 1031, things that you can jump into if you're exchange, you're not completing your transaction. I hate the term failed exchange. But if you choose not to complete it, I guess is what is more attractive comment in my eyes. But from my perspective, a failed exchange would be something that's improperly structured. A lot of times people just failing to complete an exchange due to the fact they couldn't find anything or find something suitable. That's something where you've elected, hey, I don't want these things, and I totally understand that. And if you're choosing to terminate a transaction, it's really critical you understand when you need to do that and when you're entitled to the money that's there. So 3 property rules, pretty straightforward. 3 properties of any value. You want to ID more than 3, you can. Total value of the properties ID can't exceed 200% of the relinquished property's value. Third choice, you can exceed 3 properties. The value of those properties can exceed the 200%, but you've got to close 95% of the aggregate value of all properties ID'd, meaning you're closing everything you've identified. Now, I know some great brokers, great investors, negotiators, but do you want to be tasked with closing everything? What happened if you have one sale fail and it sticks you under that 95%? Now you lose the whole thing. So when we're looking at transactions, lots of replacement properties that are smaller or bigger, and we're exceeding the 3, and they're exceeding the 200%. Really, it's one of those things where do whatever you can to get it done inside the 45 days. So, I guess one other statement I'd like to make. Everybody assumes the exchange company's got to get this ID. I would encourage you to get it to us. If you're audited and the auditor reaches out to us and we don't have it, you're probably going to have some questions to answer, but technically it could go to anybody that's a party to the transaction without an agency relationship. So just food for thought there. When can I get my money? Now, we've been in a crazy market this year. Now, really this fall, we've been busier than we've been since before the prior crash. I mean, it's been amazing the volume that's being done right now. And it's being done for a variety of reasons. But, a lot of it is because people are concerned about what's been proposed. Mr. Biden's tax proposals are honestly scary. We'll talk about them a little bit more in a minute. But, we've got lots of stuff going on. But, let's say you get into an exchange and you decide you don't want to complete it. My comments about the identification a moment ago. Now, what happens if you decided after the 45th day that you wanted to go into an opportunity zone, for example? The opportunity zone has that same 180-day period a 1031 does. Now, 1031, we used to, years and years ago, we used to terminate a transaction. If a client wanted to terminate it, pay the tax, we figured, hey, why not? Send the money out to the taxpayer, they've got the tax consequence. Well, in the early 2000s, there was a ruling came out, said, hey, if you're not following what's called the 1031 G6 rules, not only is your exchange not valid, but any exchange that exchange company does using those policies and procedures is invalid. So anybody in the exchange world that does this as a profession knows what they're doing is not going to give money outside what's called 1031 G6. In a nutshell, what it says is, you cannot receive funds until you've acquired all property you have the right to acquire. So if you're in a situation where you are identifying, let's say, 3 properties, and those 3 properties ID'd with the intent to buy one, then in our ID form, we've got actually a blank that states that you're identifying, X properties, whatever you're identifying, but you have the right to buy blank of those. So if you're working with the 3 property rule and you're in a situation where, hey, you want to use the 3 properties, but you're only going to buy one of them, you're going to write one in that blank. Now, why would we do that? Well, if you get outside the 45 days and that property doesn't take all your money, or you've decided that you want to take some money out, you want to actually receive some taxable funds as boot received at the end of the day, well, with that idea of 3 properties with the right to buy one, after you've closed on the one, you no longer have the right to buy the other 2. Therefore, we can disperse the residual proceeds. If you did not put the one in there, then we have to keep your money till the 181st day. All right. So when you get into the exchange, if you want to get money out, you can get it out at close, and it's got to be specifically excluded from the exchange. So in our assignment agreement, if you want to pull money out at close, you're going to write in the amount of money that you'd like to receive at closing, and that's excluded from the 1031. You can walk out escrow with that money. The balance of the funds are going to go forward, and now they're subject to the G6 rules, which mean at no time prior to midnight the 45th day, and after the 45th day, only after you've received all property, you have the right to buy. Once again, back to my OZ comment. If you want to go that route, if that's your fallback, you've got to rescind the ID if you've turned one in prior to midnight the 45th day. You can't rescind the ID afterwards. So it's really important that you do that. Also, think about this. Maybe you ID'd the properties, you decide you didn't want to buy any of those properties you've identified, and now you're on day 70 and you find the perfect property and we're still sitting on your money. Well, if you didn't rescind the ID pre-45 days, now we can't give you the money till day 181. And that's obviously a problem. So when you get that 45th day, today, more importantly than ever before, you are either totally completed, committed to completing the exchange, or just plan on receiving those funds. Don't leave it here if you want to do something else with it. One other comment on the napkin test and when can I get my money and pulling money out of the closing. So any money you receive or anything that's not of like kind received in an exchange is called boot. And as soon as the boot exceeds the total amount of gain, there's no benefit to the exchange. And I just sort of look at it this way: every dollar you spend beyond your basis represents tax deferred gain. And in today's world, we've got lots of people that are looking at things, and I'll have people ask the question, well, gee, the value of the adjusted value of the property that was relinquished was X, and I don't want to spend that much. Maybe it was $1 million adjusted sales price, and my perfect ideal replacement property is 900, but my basis was 5. Well, if you buy the $900,000 property, you're going to have tax exposure on that 100,000 delta between the mill and the 900, but you still deferred, gain or tax on that $400,000. So it most likely is going to help you out. But you've got to understand it's not all or nothing, and you're going to defer what you want to defer. And every dollar more you spend on something than you want costs you $1. If you don't spend it, maybe it costs you 40 cents, maybe it costs you 50 cents. I don't know, but look at it. And this is, once again, when you contemplate a sale, first call you're gonna make is you're gonna talk to your tax people, give them an idea what the asset's worth, and then you start cranking some numbers, understand what the tax hit's gonna be, and then you know whether you need to do an exchange or not, or maybe you've got a situation where you can offset some losses with the gain, so on and so forth. But that's one of our slides coming up. Exchange until it makes tax sense. But talk to your tax people, understand what's there, understand these rules, when you can get the money, because getting stuck in the transaction and not knowing where to go is not going to be, something you're happy about. So this is my first exit strategy. Swap till you drop. Been a beautiful thing for many, many years. Now the bold right in the middle of the screen, this is in the crosshairs of Biden's tax plan, but I haven't seen anything since the initial proposals there, which were pre-COVID, so we're obviously a different world than we were in. But if you look at swapping till you drop, and this was something that was a concern the last time the service was looking at, or the politicians were looking to get rid of 1031. You got to look at it in today's world. You've got the ability to 1031 until you pass away. At that point, your heir is going to receive a stepped up basis on the property when they inherit it, and they could turn around the next day and sell with no tax consequence. So this is one of those things that's been very helpful for many people. Originally, this whole thing was for farmers and all, but there's some high profile consequences. You think about if this goes away, and combine that with mark to market situation they're talking about. I mean, we've got some devastating things out there that we're going to have to be fighting to preserve. But I can see this, as something that really is going to be damaging to, let's say farmers. You've got you're land rich, cash poor, for example. But even I believe it was the Kroc family years ago with the Redskins. I think they had some situations with inheritance tax and ultimately led to a sale. But this is something to keep an eye on. And combine that with the capital gains tax rates going to normal income tax. And then, potential elimination of 1031 or elimination for 1031 for anyone making more than 400 a year. Now, think about that one. Now, I look at it and I just see the politicians, making us fight against each other right now, dividing us, the have-nots versus the haves, and so on and so forth. And I could see where they could put something out. Well, hey, we're just going to take 1031 away for the people that make more than 400. And I can see people below that saying, that's not going to impact me. Let those rich people, deal with that situation. Well, you sell a property, whatever you made on that property, it gets put on top of what you made in that tax year. So think about what that does to your income and what that's going to ultimately do to a great number of people. So if you would like to be notified as we find out more about these things, or if you'd like to join or learn more about how to fight these proposals, the Federation of Exchange Combinators, our industry's trade organization, is working hard to preserve 1031. I'm sure NAR National Association of Realtors is going to be working very hard. We've got lots of industry partners that are going to be looking at a lot of this stuff and helping us in this fight, but it is something we are gearing up for, and we're going to need your help. So swap till you drop, do it while you can. And I guess one last comment, we've got so many transactions. And the reason we're so busy right now is people are trying to cram sales into this year, or cram sales into before the turnover of the presidency. They don't want to take chances that this stuff comes into play. There's even talk of clawback provisions with these changes. So I don't want to scare people, but I at least want to make you aware that these things are being talked about. And you've really got to keep an eye on it, make sure you're getting where you need to be before it's no longer possible. So The second option here, exchange into a retirement residence. We have lots of people to do this. So if you think back on the slide comparing 121 to 1031, we talked about conversion of assets, seasoning of items. I gave you that court case where the people, relinquished the investment property, ultimately moved into the replacement property 4 months after acquisition. That's not a retirement residence thing. That wasn't their intent in that situation. But this is something that's possible. And the real question here is, how long do you have to hold it before moving into it? And that's a question that's to be answered between you and your tax people. We don't have any hard black and white guidance on that. I'd probably say a year based on two factors. One, it's been proposed a couple of times. Two, the break between short and long-term tax rates on assets held for investment falls at that 1 year. But you want your tax people on board with it, so you want to make sure they're good with whatever you're ultimately deciding. If you've got questions on this, reach out to us. We're happy to talk to you about that. So they've acknowledged this can happen, and they've given us a framework for it. First thing they did is years ago, they put a 5-year required hold on a property acquired via 1031, subsequently converted into a residence and sold. If you sold it inside 5 years, it's a fully taxable sale. And that was something that slowed that conversion and disposition without taxes. It slowed it down dramatically. It didn't eliminate it. Government looked at it years later. And in 2008, we got what's called the Housing Assistance Tax Act. You got to love the way they name these things. It does anything but help the taxpayer. It sticks it to us. And what it says is if you exchange into a property, convert it into a residence, hold it for more than 5 years, you are entitled to a proration of Section 121's 250 and 500. The proration is attributable to gain that's attributable to qualified versus non-qualified use periods from 2009 to the date of disposition. So in a nutshell, you're never going to get the full 250 or 500. You're going to get prorations of that. The longer it's been your residence, after the 5 years, the more you're going to be able to shelter. But don't understand or don't misunderstand its application and think that you can just buy a property, hold it a year or so, move into it, hold it to, dump it, take the exclusion. That's a fully taxable transaction. If you do that same thing and hold it more than 5 years, then you're going to have that Housing Assistance Tax Act applied to what you're doing. And once again, the longer you hold it as a residence, the more you're going to be able to shelter, but it's never going to go entirely away. Next option, and exchange until it makes tax sense. And I commented on this earlier, and maybe 2020 is the year, right? I mean, 2020 has been pretty crazy for all of us, and it continues to be so. So maybe you had some losses this year. If you own a restaurant, I'm really sorry. Sorry for you, and my heart bleeds out for you. But so you might have some loss. You might just have some investment properties too. So maybe you have a situation where you've offset the losses, with the gains on the property disposition. That's what we talk about when it makes tax sense. This is another reason why you talk to your tax people. Do that tax planning years in. Your financial advisors are happy to help you with things that are going on in their world too. But you want to talk to your tax people before years in, while you have time to work things out and take advantage of the laws that are there. They're there to take care of you. Don't scrimp on a great tax counsel. They're going to more than pay for themselves, and they're going to be your best friend if you're ever audited. So this is one of those situations. Look at it, understand what's going on, and sell and realize the game when you want to realize it. Keep in mind also, 1031 is not all or nothing. So you choose to defer what you choose to defer. You can take portions as boot and offset smaller losses, so on and so forth. But that's all in the planning of it. Exchange into a DST. Okay, this DST, we're going to talk about another DST in a little bit. DST is Delaware Statutory Trust. It's basically, I like to consider it an exchangeable REIT. We're going to talk about Upreits a little bit too. But a DST is something there that allows you to exchange out of an actively owned real estate piece into a totally passive investment. My mom doesn't want to deal with tenants today. You're tired of the terrible T's, toilets, trash, tenants turnover. We've got so many clients that choose a Delaware statutory trust today. And my advice, if you're looking at one of these, what you're doing is you're buying into either, it could be a single asset, but typically it's going to be a portfolio of properties. You can pick any type of, I jokingly say food group, but if you want mini storage, pick that. If you want hospitality, you're probably Brave at the moment, but you can buy that. If you want multifamily, do that. Medical healthcare type stuff. Any of these things, you can pick that little niche that you want and find a sponsor that's going to offer something in that space. And my advice on these things is work with a sponsor that's been there with history, that's strong, that's got deep pockets, that's been in the business since pre-crash last time, I guess, the way I'd look at it. The next slide, we're going to talk about tenancy and common investments, but we had in the 07, 08 crash, we had lots of people with fractional ownership assets institutionally offered that had problems. And it was one of those things where you've got to look and pick and choose who you're working with and how strong they are. And like I said, my advice is work with a sponsor that's been through the hard times. They're probably addressing situations right now, and they're working to get through them. And if they made it through the last one, they're going to be going through the next one. And think about this. I have a lot of people that are sort of leery of them because they, well, gee, I lose control, so on and so forth. I know what I'm doing, or I want to manage it. Well, I would say in this space, you're talking about some big players. Companies that have been in the business for decades and I have very deep pockets and a long proud history. They can manage an asset better than you or I can. So if you're concerned about that stuff, once again, look at the history of the sponsor, and they're going to be able to get through times that individuals probably are going to have a hard time getting through in some situations. So DST, basically you're going to relinquish your property as you normally would, just exchange into the property. One of the things that's a big gray area in this space is that how you ID the property, how you ID the DST offering, and talk to different exchange companies going to require different things. It's all gray out there. People talk about different rulings on it, but the idea is some people are going to say, well, gee, it fits in the 95% rule because if you ID one DST offering, it involves 20 properties. They're arguing that it's 20 different properties you got to identify, so it's obviously beyond, and it's going to be beyond the 200%. So you're only stuck with the 95% rule. I would look at it differently. There's case law out there supporting the fact that you've got a unified contract. It's not a it's got to be an all or nothing situation where, if you ID an offering from a DST, you don't have the ability to pick and choose which of those properties are in that DST offering. You can pick different DST offerings, but you're stuck with what that offering is. You can't pick and choose the underlying assets. So, I would probably argue that if you're IDing the offering, that you need to identify the value of that offering that you're picking up, that portion that you're acquiring. Talk about the dollars you're putting into it and the percentage of that asset that you're buying, and that should take care of you. But once again, talk to your tax and legal people, make sure they're comfortable with what's going on. If you've got further questions on that, you can reach out. But once again, it's all about the sponsor in this space, but you name it, there's a DST that offers assets in that category. So DSTs typically, it's a going concern. The financing's all set in place, things aren't going to change. DSTs actually, for the most part, are illiquid. The one downside that I see over and over again is you're typically going to be married to the asset for 5 to 7 years, and people have a hard time that. Some DSTs do offer the properties out to other investors there. At some point, I'm sure we're going to see a secondary market that would allow people to do more, but that's what you're looking at today. Now, if you're in a DST, like I said, it's a going concern. It's not typically going to be a value add situation. Fractional ownership assets, purchased using tenancy in common, you might have the same situation. You've got a limit of how many investors can come into this tenancy in common structure. TICs got sort of beat up in the early 2000s. And it's not the TIC structure that's the problem. It was the sponsors that were the problem. But the whole thing, the whole TIC structure got sort of beat up. I just, it's ridiculous. The TIC structure is just fine. If they've been around forever, it's the sponsor that you've got to look at. And it's no different than the DST sponsor situation. But, many TICs, if you're looking at why something structured as a TIC versus DST, TIC structured asset offerings are typically value add situations where they're, buying the assets, improving them, and you're going to get a check in the mail just like you would in DST, but then you're going to, pop at the end of the day too. And, just be aware that they're there and, understand what the, debt's on. Actually, one other comment, DSTs are an easy situation for IRAs, 401k plans to get into. TICs, if you're buying into a TIC, you got to make sure that any debt on that TIC is non-recourse if you want to use qualified money to buy into it. So be careful with that stuff and, understand what you're doing with it. Exchange doing an Upreit. So this is another option. So you can't exchange directly into a REIT. You can go into an Upreit. In a nutshell, you're going to buy an asset that the REIT wants. And ultimately what happens, you buy the asset, the REIT absorbs it. You're typically going to hold it for, let's say, a year or so, season the asset as something acquired with the intent to hold for investment. And then you ultimately end up, simply in that REIT. And it's a great thing. It's called 724 rollover. It's a nice deal because you can go into it and think about it's sort of the ultimate installment sale, because you can exchange into that Upreit and then sell the stock as you choose to, any year, any time, whatever you want. You're going to be in the REIT until you choose to sell those shares. When you do sell those shares, you're going to pay the tax on it. So once again, if you get it into an Upreit, ultimately there's no way out. But it is a nice end game for those people that are just done with handling real estate and are looking for a way to take the tax hit over a number of years as they choose to do it. So you've got to work with some of the DST companies offer Upreit situations too. Just ask if you're working with a financial advisor with TICs or DSTs. Ask them about Upreit offerings, and they're out there. Installment sales. Now, the next three slides are just variations on installment sale, and I would argue, an Upreit can turn, your disposition into an, in effect, an installment sale. So, the great thing about installment sales is you're going to pay tax, in the year in disposition on debt relief or in depreciation recapture, but you're going to defer, any tax on, principal payments. You need to make sure when you're selling that property on a land sale contract or note trust deed, you've got to make sure that you're getting enough of a down payment to cover all your closing costs and any tax exposure you may incur in the year of disposition. Don't find yourself in a situation where, Robert Allen, the old nothing down guy, I've been in rooms many times where somebody had a situation where it's virtually nothing down. There's not enough money to close the deal, and the seller's got to come out of pocket to pay the broker, or pay escrow, or pay me, or pay the title, the tax and legal people. Don't do that. Get enough of a down payment to cover anything you want. If you want some money out, make sure you get enough down payment to cover all your closing costs and any tax liability you might have in that year disposition. And then the balance of those payments, you're just going to pay tax on them as those payments come in via, IRC Section 453. And, one thing that comes up a lot, I know there's a couple of people that are in the 1031 world on this presentation, and I'm sure you all deal with the same situation. You get that call, somebody's getting a balloon payment on a note trust deed or land sale contract, and now they want to do the exchange. Too late. If you've got that contract, if it's yours, it's too late to do anything with it. If you're taking a seller carryback and you want to do an exchange, that note or that contract has to come to us at settlement along with the cash in order for you to have any opportunity to defer the gains on that. And we've got a variety of tools to convert that note in or contract into something that's usable in the exchange. The easiest way to do it is to sell that thing or have it a short term. Maybe you've got some work that needs to be done on the property, and maybe some type of lender require repair, and you're sitting in a situation where the buyer's 180 days coming up, they can't get the financing because of these problems. Well, they ask you to do a short-term carryback. Do it for 30 days, 60 days. As soon as it balloons, and we have the cash to complete the transaction. So you're not stuck if you carry the contract. There are many options where you may have some tax exposure. If you got questions on this, don't hesitate to reach out. We're happy to help you out. Structured sale. And one other thing, we're up on this hour already. If you're interested, the slides will be sent out to you in the future with the feedback. And so if you're having to leave, don't worry, you're going to get the slides, and we're happy to help you out with any questions you've got on those. A structured sale basically takes and institutionalizes a seller carryback. One of the big problems with seller carrybacks, or two big issues, are accelerated payoffs. So you thought it was going to go 10 years, and now the buyer's paying you off after 2, and you don't want that to happen. And the other issue is defaults. Well, anytime we're looking at institutionally structured installment sale, you can get away from those situations. You can literally structure the payoff as you need it paid off. So what happens in a structured sale is a third-party assignment company steps in, assuming all obligations, rights and obligations of the buyer of the property. They assume the obligation to pay. And what you've done is, the benefit to you is that the buyer gets to finance the purchase as they normally would, and yet you get all the benefits of an installment sale. So once again, what happens is the third-party assignment company comes in assuming the obligation to pay, and so the funds, they end up taking the funds the buyer came in with to pay for the property, and they take it and invest it. And you're typically companies like Prudential or Allstate, whole life companies, the ones involved with this stuff, and they're going to be able to structure it to get you into a different tax year or get you into a different decade payment wise. But this is something that's out there, and we've worked with it for a number of years. It's a great fallback if you've got an exchange that you didn't find anything for. But if this is something you want to integrate into the exchange agreement as a fallback, you need to let us know so we can do it. The deferred sales trust, and it's got that TM up there because the company, the estate planning team's deferred sales trust, they trademarked it, and that's what they've got. So it's the other DST, and this thing, once again, it's similar to the structured sale, but similar but different. You're still basically taking a cash sale and turning it into an installment sale. And in this situation, you've got another entity, as trust, that's stepping into the middle of the transaction, and basically you're selling to that trust, and then they are selling it to the buyer. So it's an interesting deal. It's another option. I would just make sure that you understand. And once again, just like the structured sale, you can term it to your needs, which is a wonderful, wonderful thing. But you've got to look at it and understand you're getting away from the default issues. You're getting away from prepayment issues. These are neat because they've got the ability to invest the money, and you decide the investment, you direct the investment, and then they're going to take that money. So you're going to not only contract the interest, but you're potentially looking at a pop and upside based upon what those investments, with those funds are made. And once again, it's a great deal because it's under the term that you choose to make it. The bottom line down there, just be aware, talk to your tax people on it, understand there's no IRS ruling, at least currently that I'm aware of, on this stuff. So you want to make sure that everybody's comfortable with what's going on the deferred sales trust. Charitable remainder trust, okay? Another option where you've got the ability to, why not do this? And you can literally, donate a property to a charity and receive some very nice tax benefits in that situation. You can once again tailor it to your needs as far as duration of payments and time. And it's a nice deal. You're typically going to be looking at some tax exposure on disposition. If you've got questions on CRTs, I've got a page here explaining the basics of them. Please give us a call. Tina Colson in my office has spent a decade in that space, and she's happy to talk to you about the details of it. There's companies out there that have the charitable giving departments. For example, Providence in our region, a guy Lon Dufek specializes in these things, and he's happy to talk to you about it. But they've got a whole department to help people understand how to do the stuff and take care of them in this situation. But don't worry if that charity of yours is not doesn't have it set up already. It's possible to get it set up and to take care of it. So if you've got some charity that you're interested in leaving some property to, please take a look at CRTs and understand how they work. And once again, if you got questions on them, we're happy to get you information on it and give you some guidance. Gifting. This is something I get a kick out of with real estate because most people are aware you've got a gift tax limit of $15,000 per person per year right now. That could go up, but that's what it is today. And what that means, if I give you $15,000, I gave you $15,000. People I don't know what it is about real estate though. They'll give a kid a property and they don't think about the equity in that property. You just gave the kid all your equity. And therefore, if it's in excess of 15, you could be looking at the person granting the gift is going to have a huge tax consequence in that situation. Now, something that people don't think about is gifting a minority interest in something. And with real estate, the easiest way to gift something is if you've got let's say you acquire a property, stick it in a limited liability company. Over a series of years, you can just start assigning an interest in that limited liability company. You don't have to have a deed drawn every time you do a gift. And we use that same structure with distributions on retirement accounts. I mean, everybody looks at, one of the objections Wall Street people have on using real estate or using your IRA 401k to go buy real estate is they talk about, well, what happens if you get to 72 and you've got to take a RMD, required minimum distribution? You don't have any cash there to do it. Real estate's not liquid. You could be stung. Well, it's not a problem. You're just going to take an in-kind distribution. And, by taking an in-kind distribution, you're satisfying that distribution. And you've got two opportunities there. One, the valuation. Two, if you're taking the entire asset, you're taking the entire asset and any equity in it. If you're taking a minority interest in that thing, you can discount the valuation of that distribution by up to 40%. Gifting is the same thing. So if we look at gifting an asset, if you gift the entire property, you've just given that person the entire equity in the property. If you gift them an interest in the property, and let's say it's a minority interest in the property, whatever that gift is, you could accelerate, and that number dramatically, because that number that you're limited at is, can be discounted up to 40%. So once again, this is coming back to good tax counsel and what you can talk through with them. And if they've got questions, give us a call. We're happy to talk about it. So this discounting is not new. It's been around forever. Financial advisors work with it. Your tax people work with it. It shouldn't be something that's concerning to them. Once again, we can use it actually in RMDs and IRAs and 401k plans too. So it's a great opportunity if you're juggling that estate tax limit, and especially if the limits go down, if we have a change in administrations and a change in tax laws and estate taxes. This is a situation where I just threw this slide in because, and we've only got a couple more to go. This one is something that we're doing a lot of right now, and it's just a sort of the reality of today's world. It takes so long to get a shovel in the ground. I love the old shovel-ready projects that we used to hear about, but in today's world, especially on the West Coast, how long does it take if you're building and development? If you buy a property today, how long does it take you to be able to do anything, to get a shovel in the ground on that? So the plans, engineering, permitting, all those SDCs, all that stuff has to be dealt with before you can get that shovel in. How long does it take? And understand that you've only got the 180 days for the exchange. So that's a very tough deal. So what we've seen and doing a lot of today is we're improving property already owned. And the process is something that you cannot per Rev Proc 2000-37, the Rev Proc for reverse exchanges, you can't receive property already owned as a replacement for property being relinquished. So what we do a lot of times is somebody will have a property that they've had for years, they've gotten it all set, ready to build on. Now they're wanting to build on it, they don't have the money, so they're selling something, they don't have anywhere to go with that property. They're trying to trim stuff down. So they say, hey, can we just go vertical on the property we've got? So what will happen is we go into that transaction, we take a 35-year leasehold interest in the property, leasehold interest 30 years longer constitute ownership of real property, or lease with extensions of 30 years does. So we'll create a limited liability company. In the exchange world, it's called an EAT, an exchange accommodation title holder. That LLC has us, Equity Advantage, as a member. We enter into that lease with the taxpayer for the property. We take the proceeds from the sale, go vertical in the dirt, then we assign the leasehold interest back to the taxpayer. And they truly are receiving something that by law constitutes real property that is like kind with what was relinquished. And the beauty of it is you've got the ability to hit that go button. If you're looking at different times of the year, different areas, I mean, I always joke that, when I was in California, surf goes up, the contractors, you lose them. Here we've got hunting season, everyone disappears. So, if you're going into building something during the winter, it's going to take you longer. So maybe you've got a project that's ready. We can as soon as we put the lease in place, that's going to start the 180 days. So if you want to start the project before your property goes away, you're ready to go. You got the cash to do it. We can start the project before your property goes away. And we've just are stuck with a 180-day timeline to get what we need done. Now, one last comment on improvement exchanges. It's not all or nothing. Once again, the project doesn't have to be completed, but only what is completed is going to satisfy the like-kind requirement, satisfy your exchange. So we want to bury all the money we can as fast as we can. You can't prepay labor and materials and have them sitting there and receive tax deferral for those things. Couple examples and we're done. This is a situation where we had a person come in, they had a property in Los Gatos, California, several $1 million in gain, well, $3 million in gain, going to have roughly $1 million tax hit. They didn't like that, okay? So their legal people sent them to us. We told them to move out of the house and to season it as an investment, which is what they did. They had pulled some money out of the property, went and bought the replacement home that they wanted. And then after a year's time, which was what their tax and legal people agreed was enough, they sold the property using a 1031 exchange, went out and bought 24 different replacement properties, closed them all inside the 45 days. She was husband and wife. She was a CPA. He was an attorney. She knew the consequences of dealing with the 95% rule, didn't want to take any chances. So she went from $1 million tax hit to no taxes. Still entitled to the exclusion, took that money out as they can, and then rolled everything forward in 24 different properties, closed them all inside 45 days. A very happy client. So, once again, never say never. Ask the experts in your life. Take advantage of those resources you have, and the only dumb question's the one you don't ask. Second example, this is one I just put in here. This isn't really a 1031 example at all. This is one I put in the last couple. I think it's important for people to understand if you've got a situation where you've got a problem with a property right now and potentially going to lose it or going forward next year. This situation where we had a builder developer that called us up during the last crash, and he had a $3 million property and $1.2 million lien on the thing, $1.2 million that was going to be lost in equity if the property was foreclosed. He was having economic hardships. The bank that had the loan was going out of business, been taken out of business. And so if it went away, the property's lost, and the guy was going to be losing everything. So what we did, he asked, well, can I use Dad's IRA to pay the property off? And that's a prohibited transaction, can't do that. What we did is we created a new limited liability company. Junior contributed the property, received a membership interest attributable to his equity in the property. Need evaluation by a professional to make sure we substantiate that number. And Dad's IRA made an investment into the LLC simultaneously. So now we've got the property owned by a new LLC that has the cash to pay the property off. We saved the property. Ultimately, years later, they went vertical, did an apartment complex on that project. Third example, this is a situation, it's not all or nothing. They went from a $3 million relinquished property to $1 million replacement property, tired of the terrible T's. So they gave up a multifamily project, $3 million, went out and bought $1 million retirement home in Palm Desert. And yeah, they went from 3 million to 1 million. The napkin test says across are up in value and equity for total deferral. They've got $2 million of gain that's got tax exposure. Their basis in the property was $250,000. They deferred the difference between the 250 and the million, saved them tax on $750,000 in gain, saved $250,000 in tax. So don't worry about it. If you don't want to spend all your money, understand that's okay. Every dollar spent over the basis is going to represent tax deferred gain. And just, once again, talk to your tax people, understand where that exchange is going to cease to make sense for you, but it's not all or nothing. Situation, be aware. We look at gain, understand gain, has nothing to do with profit on property. Gain is just simply a tax calculation. It's the difference between the adjusted sales price and the basis. During the last crash, we had lots of people with problems. I'm just putting this out here because I'm assuming we're going to probably have more. And if you lost a house to foreclosure, or short sale, you had tax relief. If you lose an investment property at foreclosure, short sale, you don't. So understand, once again, my statement about gain. Gain doesn't have anything to do with profit. And in a foreclosure, the sales price, is the debt on the property. So if you've got a situation where the debt exceeds the basis, you're going to be subject to something called phantom gain. And to add insult to injury, on top of losing the asset, you could pay tax for the pleasure of doing so. So just a bad situation. So in these transactions, what happened is we, the taxpayers got a question answered. Do I want to just lose the property and pay tax for doing, for the pleasure of doing that? Or would I like to come out of pocket money to buy a replacement property via an exchange? And a lot of times the money they have to come out of pocket for is less than what the tax obligation might be. So, these happen in institutionally offered investments. A lot of time the debt was non-recourse, so it didn't ding our taxpayers' credit. And so what would happen is, if it was a TIC, for example, maybe each TIC member's got an LLC, the assignment of membership interest from the taxpayer to us happens pre-foreclosure. When the property's foreclosed is ours. The exchange timelines start when the assignment of membership interest occurs. And what will happen is, instead of getting money, it's sort of funny, we don't get any money from that sale, no sale funds, but we're sitting there, and then the taxpayer is going to come out of pocket whatever's needed to buy the replacement property. So, and the value of the replacement property is going to be whatever the debt was on the relinquished property. So this is something that I hope I don't see, but I'm just putting it out there. I'm leery of it. I would not be surprised if we see more of these transactions coming up. And just food for thought, we were doing these phantom gain transactions, for those foreclosures up until last year. It was just really a tough deal. So we didn't do any in 2020, but I think 2019 was the last one we did, where we were, isolating people from that phantom gain and getting them something anyway for their money, instead of just handing Uncle Sam those funds for that phantom gain. Last example, just another thing, food for thought, and this is just a teaser for tomorrow. I had an older couple come to us, and they wanted to diversify out of Wall Street's offerings. So they wanted to take his and her retirement accounts and go out and buy a mobile home RV park. And so we said, okay, yeah, we can do that. And so we were going to structure what's called a checkbook IRA to do it. And then they told me they wanted to, be the on-site managers and live there as the on-site managers. Both those actions are prohibited transactions, not going to be allowed using an IRA. So we had to shift gears into something called a rollover business startup, or ROBS. And what that involves is instead of rolling into an IRA, we rolled each of their accounts into a new 401k plan. The 401k plan bought the C Corp, and the C Corp bought the park. Those people, those investors got an investment, got a job and a place to live, all in that one action. I think that's a pretty neat deal. So once again, we can combine 1031 funds and retirement funds to a common investment. Also, we have to use the tenancy in common structure because 1031 requires it, but that's something that's out there. I just want to mention once again, I did not put a slide in here on opportunity zones or OZs. That's another option. If you want to go, if you're in an exchange and you want to go into the OZ, make sure you terminate the transaction the 45th day, because otherwise, if you want to shift gears into it as a fallback, you're not going to be able to do that. One other thing I did not mention is the deferred sales trust. They can be used as a fallback for 1031 also. So, keep that in mind. If you got in the exchange, you're not finding what you want and you're still inside the 45 days. Thank you so much for coming today. These are a few of our services. We've got IRA Advantage, 1031 exchange, Equity Advantage, and then Post 1031 is a property listing site for people looking for assets. And once again, connect with us on YouTube. All this information, this program, this webinar will be put up, and you will have access to it for the future. If you want those slides, they're going to be coming out too, but we've also got these other sources where you can see what we've got going on. And by all means, please reach out if you'd like to be on our email list. Thank you very much for attending today, and happy holidays to everyone out there. Take care, thank you, and best of health. Bye.